In this video, I'm going to explain how to determine risk when trading futures, how I personally determine risk based on each contract. A lot of you guys are new to futures trading with the changes in the Forex and CFD prop firm space. You guys are coming to trading futures. So I want to make that transition a bit easier for you. So let's get right into it. For an example here, I'm going to use the S&P 500 and the NASDAQ, which are the two most commonly traded indices or index funds in the futures world. So I personally trade the NASDAQ, the NQ, and these are otherwise known as S&P 500, SPX 500, but in the futures world we call that the ES. The NASDAQ, the same thing, NASDAQ US 100, but we call it the NQ in the futures world. So we use these two as an example, and I'll show you in the actual charts as well how to determine these amounts. It seems to be the most commonly requested video. So getting right into it, let's start off with the S&P 500, the ES. So if you're using one contract on the ES, each tick of movement is worth $12.50 USD. Now a tick of movement is the minimum price fluctuation. So same as in the Forex CFD space, 1 pip, your minimum fluctuation in price, a pip or a pipette, whatever that is in your chosen choice of product to trade. In the futures market, it's called a tick. So it's the minimum amount that a product can move in the futures market is 1 tick. So each minimum tick of movement is worth $12.50 USD if using one contract on the S&P 500. In NASDAQ, using one contract, each tick of movement is worth $5 USD. Okay, so to find this information, I'm not just pulling these numbers out of my ass. If you're looking for whatever you're going to be trading, whether it's the index funds or currency futures, go to the cmegroup.com website, and I'll show you that. If you go to the cmegroup.com website, this is the official futures exchange, the centralized market, which we all trade on, the CME, and then you go over to markets. You can select your product. So if we're looking at trading the S&P 500, the ES, you click on that. It'll take you to the product page. All you do is you go over to specs, click on specs, scroll down to where it says minimum price fluctuation. Then you have a look here and underneath the top where it says outright. You're looking at 0.25 index points equals $12.50. So 0.25 is 1 tick for the ES, S&P 500, and each tick of movement is worth $12.50 per contract. It really is pretty simple, guys. And if you're unsure, just come to this website, check whatever product you're trading, then you can see what the minimum price fluctuation per contract is. $12.50 per tick, and same thing for NASDAQ. Same thing, $5 USD. We go here, markets, click on the NASDAQ, and click on specs. Scroll down, minimum price fluctuation, outright, 0.25 index points, which is 1 tick, is worth $5 per contract. It's always in USD as well, by the way. So that's how you determine the dollar amount per tick per contract. Now, how do we use this to determine risk? Well, determining risk, your stop loss would be your tick amount times the tick value per contract. So if you were trading the NASDAQ, for example, and you had a 40 tick stop loss on NASDAQ with one contract, that would be 40 ticks times $5 for one contract would equal $200. So 40 times 5 equals 200. And if you're trading the S&P, 40 tick stop loss on ES with one contract would be 40 ticks times $12.50 for one contract equals 500 USD for that stop loss placement. So I'll show you, we'll jump over to TradingView now, and I'll show you how that looks in action. There's also an easier method to do this to determine what your risk will be using TradingView's built-in position size calculator. We'll jump over to TradingView now and I'll show you what that looks like in action. Okay, so here we are in TradingView. If I want to be looking at the NASDAQ, for example, I'll just type in that code, which is NQ, as mentioned earlier in the video, NQ. That'll bring up the E-mini NASDAQ. I'll then select the NQ1 exclamation mark, which is the continuous contract, means you'll always be trading the front month. It's just easier for beginners especially. NQ1 exclamation mark will make sure you're always trading the front month. And now say for example, I want to place in a limit order. I want to go short from this level here, from where these green upwards candles are. So I might be anticipating that price will come up and tap that area and continue back down, for example. Let's say that's a trade I want to look at. So to determine my risk, Here's an easy way to do it in TradingView. So on the left column here, you have all these tools. If you go 1, 2, 3, 4, 5 options down, then click the little arrow to the right. These are your measurement and projection tools. So if you want to measure out a short position, so you want to sell, click the short position. And then on the chart, you want to click, where do I want to go short from? I want to go short from this level here. Okay, so if price comes back up to this level, that's where I want to short from. It'll place a measurement tool on the chart. Now, if I want my stop loss to be at the swing high here, okay, I want to have my stop loss placed right there. I'll drag this tool down to that point, all right, and that'll tell me where my stop loss will be. And if you look at the middle number here, where it says 59, just above my cursor, where it says 59, that is how many ticks I'm risking from my desired point of entry. I'll be risking 59 ticks. And then for my take profit, say I target the low down here, targeting 119 ticks. So risking 59 ticks to make 119. All right, that's how you can measure the distance between your entry and your stop loss. And you know, if you're a bit old school like me, you can just have a look, say, okay, 59 ticks. I'm on the NASDAQ, which is $5 per tick per contract. I'm going to be trading one contract. All I have to think is, okay, 59 ticks. 59 ticks times $5 equals 295. This is generally how I calculate risk. I just pull out the calculator, or I do the math in my head, and I times the ticks by the amount of contracts that I'm using, the value of the contracts I'm using. So you can do that, but there is an easier way to do it as well, guys. You don't have to use a calculator like me. So if you've placed your tool like this, okay, this is the position you desire, right click, click create limit order, and that will automatically fill in the settings for a short order from that price point. Okay, so that's using one contract. It's already calculated here. Your stop loss is 59 ticks. Would be risking $295. 59 times 5 equals 295. Okay, and same thing for your take profit. It's already calculated that 119 ticks times $5 equals 595. That's for one contract. Now, if you wanted to trade more contracts, all you can do is backspace. Say you want to do 2 contracts, 3 contracts, 4 contracts, 5 contracts. It will readjust your stop loss and take profit settings to risk that certain amount. So say if on this trade, I only wanted to risk $100. Say I want to risk $100, it will readjust what my stop loss should be if I only want to risk $100. So it's readjusted that to 20 instead of 59. So then if I only want to risk $100 on the trade and I've put that in there with one contract, I've entered in my desired amount of risk, $100, I just click sell, and that'll automatically fill in my position there. Okay, you can see it's got my stop loss there of $100 and my take profit of $595 with one contract. So you can use that tool to determine what dollar amounts you'll be risking and using as your take profit. It's an easier way to calculate things for some people. Myself, I just prefer to use the calculator on my phone. So that's how you do it. That's how you determine your amount you're risking per trade, depending on the contract. Myself, when I'm trading, if you guys have watched me trade live, you see how I do it. I normally just place in this tool here, eyeball the amount, say 47 ticks, whatever. If I want to get a long position from here and I have my stop loss at the swing low, I just look, okay, 22 ticks times one contract is $110. It's 5 times 22, $110. Just a little bit of quick math on the fly. You know the product you trade, if you're familiar with what you trade as you should be, you know, with NASDAQ, I know off the bat that it's worth $5 per tick per contract. And even better, if I'm using 2 contracts, it's 5 times 2 is 10, right? 2 contracts, $5 per tick each. 5 times 2 is 10. Easy. Okay, 10 times 22 is 220. So I know if I'm to enter with 2 contracts here, it'll be a $220 stop loss if I place my stop loss at this low. So it gets more familiar with time. That's how I do it right off the fly. Or you can use that position tool calculator by opening up that order window here. So depending on what you trade, make sure you go to that CME Group website, cmegroup.com. Look up the particular product you're trading, look at the minimum price fluctuation so you can see what the tick value is per contract. So then you can figure out, okay, how many ticks am I risking times the amount of contracts I'm using equals what for my stop loss and take profit. So it comes with a bit of time, but I hope that video helps, guys. Let me know in the comments below if you want to see more content about how to trade futures. Any questions you have, please do let me know in the comments below so that I can assist you with this transitionary journey to trading futures. It's a bit overwhelming at the start, but trust me, once you get into it, all the terminology and the way to work these systems becomes pretty simple. So let me know, guys. Thumbs up if you like the video. Make sure you subscribe. I trade futures live Monday to Thursday during the London session and the Asian session at the moment. So if you want to watch it happen live as well, if that helps you with your learning, 7 p.m. Eastern time and also 2 a.m. Eastern time is when I'm live. So take care, guys. Hope that helped.